Okay, everyone, I think we're right at noon, and in the interest of your time today, we'll get started. Just a few housekeeping items to go over before we get started. This webinar is being recorded and it's also being streamed live on Facebook. Um, some of us don't use Facebook that often, so if you have questions on how that works, please don't ask me. Everyone who has joined as an attendee is on mute. That's intentional. We'd ask that if you have questions or comments to please enter them through the chat. I will be monitoring those throughout the webinar, and some of them we may answer as we go, and some of them I will interrupt on your behalf. And at the end of the webinar, we will be sending out a short survey. It is a link from, I believe, Google Forms. That's my understanding. So we would greatly appreciate any feedback that you could give us. With that, I think let's go ahead and get started so that we can move along and respect everyone's time. So today we're here to talk about all of the lease accounting that those of you that know me, we've been talking about this as CPAs for probably close to 12 years, maybe 13 at this point. A lot of changes are coming very soon. So our webinar is entitled Lease Accounting, What's New and How Does It Affect You? I'd like to introduce our panelists today. First, and in my bottom right corner is Joseph A. Giordano, who is our CEO, and we basically consider him the patriarch of our firm. He is a technical accounting and auditing wizard, in my opinion. We use him as our research guru, if you will. In my top left is Julie Morgan. Julie is the director of our accounting and auditing department. She has 20, almost 30 years of experience dealing with all types of entities. And in my bottom left is Frank DeFroda. Frank is also in our accounting and auditing department. He's on our internal accounting and auditing committee. He is a nonprofit and government specialist. So with that, I think I'm going to turn it over to Joe Sr. or Joseph A. Giordano. I think you're going to kick us off.
Good morning, everyone. I guess maybe it's afternoon. And like Joe said, today's webinar is to provide an overview of the new accounting rules for leases, which become effective for years ending after December 15th, 2021. Our primary focus today will be on the lessee. So let's review what's happened over the last quarter century plus. Lease accounting has been controversial since the FASB released Statement 13 in 1976. With that pronouncement, the FASB introduced 4 bright lines to determine if a lease should be capitalized. That is, whether the asset and related debt should be recorded on a company's balance sheet. Nobody wanted to do this, so in short order, leases were structured to avoid capitalization. And as a result, the FASB in 2006 undertook a project to study lease accounting. The goal was to increase transparency and eliminate loopholes that allowed for off-balance sheet financing. After years of study, including the solicitation of comments through the FASB process and numerous rewrites, Accounting Standards Update 2016-02, simply entitled Leases, was issued in February 2016. The FASB believes the new guidance improves the quality and comparability of financial reporting. So under the new guidance, a lessee will be required to recognize assets and liabilities for leases with lease terms of more than 12 months. The asset represents the lessee's right to use the lease asset, while the liability represents the obligation to make payments under the lease.
Hey, if I may, Julie, are there exceptions to the new lease standard?
Yeah, Joe, there are. The new lease guidance doesn't apply to leases of intangible assets, leases to explore for or use minerals, oils, and natural gas, leases of biology assets, leases of inventory, or leases of assets under construction.
Just to clarify, because I know when I think of an intangible asset, I think of goodwill. Could you give an example of a lease of an intangible asset?
Well, yeah, Joe, I was thinking leases of software, leases of patents.
Okay,
Those could fall under intangibles.
okay, thank you.
On the slide, you'll see a short sample of a balance sheet. And as you can see, the right of use asset is separated. And then the lease liability is broken down into current and long-term portions. So, consistent with current GAAP, the recognition, measurement, and presentation of leases by a lessee depends on its classification as a finance or operating lease. However, unlike current GAAP, which requires only capital leases to be recognized on the balance sheet, the new accounting for leases requires both types of leases to be so recognized. Let's start with finance leases. Here, most leases other than property, equipment as an example, will qualify as a finance lease. For a finance lease, a lessee will recognize that right of use asset and a lease liability initially measured at the present value of the lease payments. To recognize interest separately from the amortization of the right of use asset in the income statement. And the unwinding of the discount on the lease liability would be the interest expense. And in accordance with the finance lease, repayments of the principal portion of the lease liability would be classified within financing activities on the statement of cash flows. For operating lease, the initial balance sheet presentation is exactly the same as that of the finance lease. You recognize the right of use asset and the lease liability, again measured at the present value of the lease payments. And here's where the differences begin. With an operating lease, you would recognize a lease cost in the income statement calculated so that the cost of the lease over the life of the lease term is recognized on a straight line basis, and all cash payments would be recognized in the statement of cash flows within operating activities.
Hey, Joe, just to clarify so that everyone understands what we mean by leasing property as such as land or a building, the office that I'm sitting in, we rent from one of our local commercial real estate agencies. That is what we're referring to. That will now be on your balance sheet and Joe Senior talked about the date, years beginning, after December 15th, 2021.
Yeah, that's exactly right. We would, let's just say we have 5 years at $10,000 a year. We would, and discounted, it's 40,000. We would recognize a right of use asset for this office space of 40,000 with a corresponding lease liability of 40,000.
Thank you, Joe. Just an additional question for Frank. What would happen in our industry? We use a term such as materiality, What happens when a lease is not material?
Okay, Joe, good question. So for those who don't know, the international standards use a threshold of $5,000 for this requirement. However, the FASB and ASU 2016-02 did not provide a low value exemption. However, they stated that entities will be able to adopt a reasonable capitalization policy under certain leases below an identified threshold would not be capitalized. So here the operative word, Joe, is reasonable. So let's take these two considerations. The first being some organizations might align this standard with your current fixed asset schedule, your current fixed asset policy, okay? Because if you think about it, when capturing a lease on the financial statements now under this new standard, you record the right of use asset on your balance sheet, which would also be similar to other long-term assets on your balance sheet. So right now you have property, plant, and equipment on your balance sheet as a non-current assets. So by adopting this approach, using the same materiality threshold for your capitalization policy, it would be consistent. Another consideration when deciding to adopt this is basically looking at your debt covenants, okay? Because many private companies follow generally accepted accounting principles, so they have to comply with bank requirements relating to the bank debt covenants. So it's important to consider the impact of this new lease on your debt covenant, okay? So even though a lease might be considered small for purposes of transparency, you might elect to follow this standard so that the bank gets a truer picture of your financial statements, Joe.
Right,
Okay.
and that's particularly of important when your debt covenant is a debt to equity ratio. This will qualify as both a current, you'll have a current portion and a long-term portion. So depending on what your covenants are, that could be a significant issue.
Okay, now that we know there are two forms of leases, how do we distinguish between a finance and an operating lease? So we need to examine the major considerations in a lease. First, do the payments represent substantially all of the fair value of the asset, of the underlying asset at lease commencement? And in order to make this determination, you need to know the fair value of the asset. Is the lease term for the major portion of the asset's economic life? Is there a bargain purchase option that the lessee is reasonably expected to exercise? The key words here is reasonably expected to exercise. Does title transfer automatically at the conclusion of the lease? And the asset is of specialized nature that has no alternative use to the lessor at the end of the lease. There's one more factor to consider. A lease should be classified as a finance lease if the lessee has a significant economic incentive to exercise an option to purchase the underlying asset. So you can go to that. So let's summarize. For a finance lease, if any of the criteria, the 5 criteria are met, the lease is a finance lease. As stated, leases of equipment will generally be finance leases. If none of those 5 criteria are met, you would classify the lease as an operating lease. And generally speaking, they will be of property and land. And Joe's example of our lease of this space would be classified as an operating lease. Frank?
Okay, we have a couple of examples we'd like to share with you. The first being a finance lease, okay? So the scenario is a lessee enters into a 10-year lease for equipment with an estimated total life of 12 years. The lease payments are $9,000 a year, the present value of which is $69,500, calculated using a 5% interest rate implicit in the lease. The fair value of the equipment is $75,000 at the commencement date. So the first thing you need to do is refer back to the previous slide that Joe Sr. went over, describing the 5 areas that would qualify as a finance lease. So based on this example, the leasee determines that the lease is a finance lease based on the following. The lease term is for more than an insignificant part of the economic life of the asset. So for instance, 10 years is the lease over a total life expectancy of 12 years, that comes out to 83%. So that is significant to the asset. Number 2, the present value of the lease payments is more than insignificant relative to the fair value of the equipment at the commencement date. So for instance, the present value of this equipment was $69,500 and the fair value at commencement was $75,000. So if you take $69,500 divided by $75,000, you get a 93% ratio. So again, it's significant to the asset. So it will be classified as a finance lease. The next example is an operating lease. So the scenario here would be a lessee enters into a 15-year lease of an office building with an estimated remaining economic life of 40 years at the commencement date. The lease payments are $30,000 a year, the present value of which is $300,000, calculated using the lessee's incremental borrowing rate, because the rate the lessor charges is not readily determinable. The fair value of the office building is $400,000 at the commencement date. So again, going back to the 5 criteria, you go back and you analyze, and the result is it's an operating lease based on the leasee determines that the lease is an operating lease based on the following. The underlying asset is property, okay, which is important. The lease term is not a major part of the economic life of the property. So the lease was 15 years over the total life expectancy of 40. That ratio is about 38%. So you can see that as insignificant to the total life of the asset. And finally, the present value of the lease payments does not account for substantially all of the fair value of the property. So again, if you take the $300,000 present value divided by the total fair value of $400,000, that gives you 75%, which is not considered material. So that would be an operating lease.
Thank you, Frank. I know I'm not the only one whose head is starting to spin. So just to make this more complicated, hey, Julie, are all leases easily identified?
No, they're not, Joe. So certain leases are buried within a larger contract and may not be labeled as a lease. The new lease standard requires us to identify embedded leases and account for it accordingly. So as an example, a company enters into a contract to advertise on a billboard. The contract here could be written as an advertising service contract, when in reality, the right to use the billboard may meet the definition of a lease. So once we've determined that the contract contains a lease, an entity should identify each separate lease component within that contract. In this respect, the right to use asset is considered to be a separate lease component if the following criteria are met. If the lessee can benefit from the use of the asset on its own or together with other resources, and if the underlying asset is not dependent on other underlying assets in the contract.
I'll bet our attendees are all saying, man, I'm going to start to have a lot of questions for my accountant.
Let's move now to the lease term. The lease term is the non-cancelable period for which the lessee has the right to use the underlying asset and let's leave it at that for just a moment. This is one of the key ingredients in determining the right of use asset and the lease liability. So we talked about the non-cancelable period. It may include periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option, as well as periods covered by an option to terminate the lease, again, if the lessee is reasonably certain to exercise that option. The lease term begins on the commencement date and includes, in the calculation of the right of use asset, it includes any rent-free periods provided. Needless to say, judgment is really needed as to what options may be exercised.
Hey, thank you, Joe. Do you mind giving us an example of when you would include the option to renew in your calculation?
Sure. Let's just say you have a manufacturing company renting a warehouse. The lease is for 5 years at $50,000 a year with an option to renew for 5 years for $55,000 per year. At the inception of the lease, the manufacturer invested $300,000 in renovations. Those renovations might include shelving, heating and air conditioning, as well as other modifications to the warehouse. Let's just say that the shelving is immovable. In this scenario, logic would prevail, and it's reasonable to include the option period in the lease term. So let's move on and look at some of the additional considerations when determining what to consider. So we talked about the option to extend or terminate. Economic incentive, we just gave you an example of that. Contractual terms and conditions could enter into this issue. Improvements, leasehold improvements. Costs related to termination coupled with a new lease. As an example here, the location of a specialty store, a coffee shop, a restaurant, possibly even an ice rink, are critical in the traffic that will be attracted to their business. And of course, the importance of the underlying asset to the lessee's operation and if there's any specialized assets. So we've already said under the new standard, the lessee recognizes a lease liability equal to the present value of the lease payments. This application is required regardless of whether the lease is determined to be operating or finance. And I know we've beaten that up, but that's critical. That's a critical point in this. The difference between an operating lease and a finance lease is in the subsequent measurement. So what's considered? What is important to understand in lease payments? The first one, fixed payments, adjusted for lease incentives received and certain other payments and costs. Variable lease payments. These are payments made for the right of use that vary because of changes in facts and circumstances occurring after the commencement date.
So, Joe,
Yeah.
if I may, in a variable lease payment, a factor, if you're renting space, could be common area maintenance.
Yeah.
Just wanted to throw that in as an example. You can,
Yeah.
I'm sorry for interrupting.
Yeah, a good example of a variable lease payment might be a specialty store that makes a deal for a lease payment that may be below fair value, but adds a payment of, say, 2% of sales for a month. The exercise price of an option to purchase the lease asset, if it is reasonably expected that the lessee will exercise that option. And then there's a few other payments that are noted on your screen.
Frank, we just touched on it a little bit. Does the new standard specifically define variable lease payments? Frank, I think I think you're muted.
Sorry about that. Yes, the new standard does define variable lease payments as those made by the lessee to the lessor for the right to use an underlying asset that vary because of changes in facts and circumstances occurring after the commencement date, as Joe Senior referred to before. A couple of examples, lease payments can be linked to price changes due to changes in an external market rate or index, for instance, Consumer Price Index, CPI. So that could, you could have it, your lease payments go up 3% each year, for the next 5 years. Another example is a lessee's performance derived from the underlying asset, such as a percentage of sales revenue. An example here, you might have a new company, a coffee shop that's just starting out in business, and they can't afford the normal $20 per square foot rent. So the landlord charges them $10, but then charges them, 2% of their sales per month. So that would be an example of that. And then finally, use of the underlying asset. For instance, a car lease may require the lessee to make additional lease payments if you exceed the mileage at the end of the lease. So those are several examples of variable lease payments.
Thank you, Frank.
So at lease commencement, the lessee initially measures the lease liability at the present value of the lease payments, discounted using a rate established at the commencement date. That rate is the rate implicit in the lease if known. Otherwise, you would use the lessee's incremental borrowing rate. Certain variable lease payments should be included in the initial computation. And before going further, it's important to understand that there are two categories of variable lease payments. The first category are payments that change based on a rate, such as the Consumer Price Index. And the second category is real easy. It's everything else. Only the first category, okay, is included when measuring and classifying a lease, and subsequent changes in the original index are treated as variable lease expense. It's important to note that the lease liability should not be remeasured when the index or rate changes. So now that we know that the present value of the lease liability, when can we compute the initial measurement of the right of use asset? And that consists of the amount of the initial measurement of the lease liability plus lease payments made on or prior to the commencement date, less lease incentives, and any initial direct costs incurred. Let's talk about lease modifications for a little bit. They're defined as any change to the contractual terms and conditions of the lease that was not part of the original terms and conditions of that lease. If a lease is modified, the modified contract needs to be evaluated to determine whether it is or still contains a lease. If a lease continues to exist, the modification can result in a separate contract, which may or may not be a lease, or a change in accounting for existing lease and not a separate contract. It's important to note that the lessee, as well as the lessor, should account for a lease modification as a new lease separate from the original lease when the lessor, and only when the lessor, grants the lessee an additional right that is not included in the original lease. So that might be, the original lease was 5 years, and now we're getting close to the end, and the lessor says, hey, we'll add a provision that you can renew for another 5 years. In such a case, the additional right of use is priced commensurate with its standalone price. Generally speaking, that will be part of the extension. So if you're paying $20 a square foot, they might say, we'll allow you $21 a square foot. Just as an example, we had an original lease here. Joe renegotiated it, and they actually lowered the lease for a short period of time. A lease modification not accounted for as a new contract requires the lessee to reassess the lease classification as well as remeasure the lease liability. And of course, the right of use asset should be adjusted by the amount of change in the remeasured lease liability. Very quickly, yes, a lease can change from operating to finance, depending on the provisions. Every one of these modifications can be rather complex. Judgment is important, and they need to be analyzed carefully. Here's an example. In the 7th year of a non-cancelable 10-year lease, a lessee makes a significant leasehold improvement, which has significant value to the lessee. The lessee now has an economic incentive to exercise an option to extend the lease. The option to extend the original lease, the option to extend was in the original lease. So since the option to extend the lease was in the original lease, the lessee's exercise of the option is not considered a lease modification. Irrespectively, the right of use asset and the lease liability will probably need to be adjusted. Had the option to extend been a contract or lease modification, that is, it wasn't in the original terms, then we would have a lease, when we have a lease modification, we'd be required to reassess the lease classification as well as remeasure the lease liability and, of course, the corresponding right of use asset. So let's summarize this. Accounting for the right of use asset at the commencement date is the sum of the initial measurement of the lease liability plus payments made to the lessor at or before commencement date, less lease incentives received from the lessor, plus initial indirect costs incurred by the lessee, such as commissions, legal fees, etc. Correspondingly, the lease liability at commencement date, we measure the lease liability at the present value of the lease payments, discounted using the rate the lessor charges, if known, or the lessee's incremental borrowing rate. And there is an option to use a risk-free discount known as a practical expedient for non-public entities. I will say, if you elect that practical expedient, the lease liability will generally be higher than using your incremental borrowing rate.
Joe, you used a word that I want to just touch on. There are other practical expedients in these provisions. We're not going to touch on those too much today because, as I understand it, and Julie and or Frank jump in and confirm what I say to be true. My understanding of the practical expedients is they are more at an individualized level in your company or your nonprofit or government or whatever. Is that correct?
Yeah, you know, Joe, so the material that we're covering today is the lease standard. And so these standards apply to everybody. And you're right, there is a practical expedient, but it would be an entity by entity decision. So, I would just say that if anybody's interested in discussing the practical expedients, just give us a call and we can talk about it in relation to your individual entity. Good?
Thank you, Julie.
So let's talk about the presentation of the financial statements, and keep in mind, with the exceptions that we noted earlier, this standard does apply to for-profits and nonprofits alike. So first, with the balance sheet or the statement of financial position, a lessee should present all of the following: the right of use assets separately from other assets, the right of use assets from financing leases separately from leases arising from operating leases, the lease liabilities separately from other liabilities, and then the lease liabilities from finance leases separately from those arising from operating leases. Because the presentation of all this information can be cumbersome, many entities are presenting a single line for the right of use asset, a single line for the lease liability, and then expanding the presentation in the footnotes to the financial statements. So let's take a look at the statement of comprehensive income. The lessee should present, for finance leases, the unwinding of the discount on the lease liability separately from the amortization of the right of use asset. In that respect, the income statement approach for finance leases assimilates that if you purchase the asset with debt, which makes sense, right? Because after all, it's a finance lease. For operating leases, the lessee should present the unwinding of the discount as a single lease cost. In other words, you would combine the unwinding of the discount with the amortization of the right of use asset on the straight line basis. Let's look at the statement of cash flows. For finance leases, cash payments for the principal portion of the lease liability are presented within financing activities. Cash payments for the interest portion are presented in accordance with ASC number 230, Statement of Cash Flows, which generally requires interest to be reflected in operating activities. For operating leases, cash payments for the lease payments are presented within operating activities, except for payments that represent costs to bring an asset to the condition and location necessary for its intended use. These payments are presented within the investing activities. We believe any changes in the lease liability and changes in the right of use asset should be separately presented as adjustments to net income within operating activities. So for example, a decrease in the right of use asset would be a non-cash increase to net income. A lessee should present such amounts gross in the statement of cash flows or provide proper disclosure if they're presented net. A lessee should also appropriately label such adjustments in the statement of cash flows. For example, changes in the right of use asset could be described as non-cash lease expense, but should not be labeled amortization expense. There are a few issues that impact both types of leases on the statement of cash flows. Lease payments for short-term leases not recognized on the balance sheet and variable lease payments, which aren't included in the lease liability, are presented within operating activities. And non-cash activity, for example, the initial recognition of the lease at commencement, is disclosed as a supplemental non-cash item. So now let's talk about disclosures. The overall objective of the disclosure requirements is to enable users of the financial statements to assess the amount, timing, and uncertainty of cash flows arising from the leases. In order to achieve that objective, a lessee is required to disclose qualitative and quantitative information about its leases, the significant judgments made in applying the requirements to leases, the amounts recognized in the financial statements relating to those leases, and a leasee or lessee needs to consider the level of detail necessary to satisfy the disclosure objectives and how much emphasis to put on each of the various requirements. The lessee needs to aggregate or disaggregate disclosures so that useful information isn't obscured by including a large amount of insignificant detail or by aggregating items that have different characteristics. A lessee shall also disclose all of the following. First, information about the nature of its leases, including a general description of those leases, the basis and terms and conditions on which variable lease payments are determined, the existence and terms and conditions of options to extend or terminate the lease, the existence and terms and conditions of residual value guarantees, the restrictions or covenants imposed by leases, for example, those relating to dividends or incurring additional financial obligations. A lessee should also identify the information relating to subleases included in these disclosures. Second, a lessee shall disclose information about leases that have not yet commenced, but that create significant rights and obligations for the lessee, including the nature of any involvement with the construction or design of the underlying asset. Third, a lessee shall disclose information about significant assumptions and judgments made in applying the requirements, which may include the following: the determination of whether a contract contains a lease, the allocation of the consideration in a contract between lease and non-lease components, and the determination of the discount rate for the lease. So next, for each period presented in the financial statements, a lessee shall disclose the following amounts relating to a lessee's total lease costs: the finance lease cost, segregated between the amortization of the right of use assets and interest on the lease liabilities; operating lease cost, short-term lease cost, variable lease cost, sublease income disclosed on a gross basis, separate from the finance or operating lease expense, net gain or loss from sale and leaseback transactions, and finally, disclose amounts for the following items: the weighted average remaining lease term. The lessee should calculate the weighted average remaining lease term on the basis of the remaining lease term and the lease liability balance for each lease as of the reporting date, and disclose the weighted average discount rate. The lessee should calculate the weighted average discount rate on the basis of the following: the discount rate for the lease that was used to calculate the lease liability balance for each lease as of the reporting date, and the remaining balance of the lease payments for each lease as of the reporting date. So that's a lot. There's a lot of information in there. I hope you're still with me. We have a couple other items that we want to discuss as well. So Joe, take it away.
So here's a really important issue: is what happens when there are related party leases. Well, the recognition and measurement requirements for all leases should be applied by lessees and lessors, even though they're related party, based on legally enforceable terms and conditions within the lease. Leases, in addition to what Julie just talked about in regards to disclosures, you would have to disclose related party transaction. So the important question here is what happens when consolidated financial statements are prepared because the lessor is deemed a variable interest entity. So let me see if I can't do this in a logical sense. A variable interest entity happens in this situation. I own a manufacturing company. For legal purposes and liability concerns, I put the building that we manufacture our product in a separate LLC. And the separate LLC is the lessor, and it leases to the manufacturing company. In this particular case, I own 100% of both. It's a related party transaction, and the asset is already booked on the lessor books and records. And it's deemed a variable interest entity, so we have to consolidate the financial statements. Consolidated statements are really done to present an entity as a whole. In other words, as if it were one entity. In this particular case, it would not make sense to book a capital lease on the lessee's books and a sales type lease on the lessor's book. In other words, the lessor is selling the asset, for the simple reason that all that would be eliminated in the consolidation. So when you have consolidated financial statements, you probably don't need to go through all this. Let's go another step. I own the manufacturing company. I own 10% of the lessor, and somebody else who is unrelated to me owns 90%. It's still a related party transaction because of the fact that I own 100% of the manufacturer and 10% of the lessor. But you wouldn't consolidate here because it wouldn't be considered a variable interest entity. And therefore, on the books, and because it's not a variable interest entity, you wouldn't consolidate. So therefore, on the books of the manufacturing company, we'd have to capitalize the lease, as we've been talking about. And Joe asked me a question with regards to a client that he has that has a month-to-month lease. But he's had that month-to-month lease for about 10 years, maybe more. And here, substance over form applies. What really is the substance of the lease? Yeah. We're just going to go for about less than a minute about lessor accounting because it's complex and we would have to really go into detail. There are 3 classifications. The first is a sales type lease. And when you have a sales type lease, you recognize the profit on the item being, in essence, sold. Then you have a direct finance lease, and the profit on that lease is recognized over the life of the lease. And then you have an operating lease, which is simply accounted for as you go. I think we can move on.
Just so everyone knows, we're getting right to the end. We're coming in for a landing very shortly. Bear with us a few more minutes.
Yeah, this won't take long. There is a transition approach, and I'm going to make this really short. You can, let's just say that you're going to apply the new lease standard. You're the lessor. You're a lessee, and you're going to apply the standard for 2022. You have an option of whether to apply the transition only to 2022 and not modify 2021, even though they're presented as comparable or comparative statements. And what you do is you do that through a cumulative effect as of 1/1/22. The other option is to transition by restating 2021. Just a
So, hey,
few. Yeah,
Joe Senior, can I just clarify something?
Yep.
So that means you have to know the effect of 2021 so that you can adjust at the beginning of 2022. I just
Right.
want to make sure everyone fully understands that. You know, we can't say, oh, we'll just wait until 22 and handle it at the end of the year.
No,
You want to start preparing for this now.
right, and depending on who your users are, some users may not accept a cumulative effect at 1/1/22. They may want the 2021 financial statements restated, so you're in essence applying this as of 1/1/21 for purposes of whatever those users' needs are, whether it's a banker or a stockholder or whomever. So let me just make a few closing remarks, and then we can talk about questions. Joe just said it. It's a very complex undertaking that requires diligence and judgment. Of particular concern, Julie talked about embedded leases. That's really important. So contracts have to be analyzed, because if there's a lease embedded, we have to account for it as such. Advanced preparation enhances the process and expedites the entire accounting, financial statement presentation, and the disclosure. And third, because you now have an additional liability on your books, Frank mentioned this earlier, you might have covenants in your financing with a bank, and those covenants could be upset when we transition to the new accounting for leases. So you have to be very careful here, and it's probably a good idea to talk to your banker earlier rather than later.
And Joe, if I may add to that, and I have seen our attendee list, we have a few bankers with us today. If you know you have a few clients that have restrictive covenants that could affect, you may want to start talking to your credit people and then talking to your clients as well. And finally, I think we're going to open up for any questions. If anyone, this, Joe Senior said it, Julie said it, Frank said it. This is a very complex topic. It is a major undertaking. We have one client that has publicly traded bonds, so they had to comply with PCAOB standards, and they already, publicly traded companies have already adopted this standard. It is a major undertaking of time, particularly if you have a lot of leases, whether they're equipment, vehicles, space, locations, whatever the case may be. I would highly recommend starting the process now, months and months and months in advance, so you're really prepared. With that, any questions? I don't see any in the chat. I know that when I first went through this, my head was spinning, and I'm supposed to know about these things. So don't feel like if your head's spinning, we understand. But we have about 6 minutes left. We're happy to answer any questions. If you would like, you can feel free to reach out to us directly, and we'll try to help you with your questions. With that, we're going to stick around a few more minutes. I know Julie has a hard stop at about 1:03. So if you have questions for Julie, get them in now. If not, the rest of us can stick around a few extra minutes if you need us to.
And if you ask me any questions, I'll just tell you, I'll ask Julie to get back to you.
That's what we deal with every day here, guys.
Well, I think, Joe,
Seeing no questions come in. Go ahead, Joe.
Oh, I was going to simply say, I think you summed up everything pretty well, Joe. And we're happy to answer any questions.
I-
Go
I
ahead.
have one right now. When should a lease be set up as a liability as opposed to an expense?
Well, any lease over 12 months would require us to implement the new lease standard. And therefore, the liability would be.
However, while you want to start measuring this, and Joe, I think I'm going to jump in because I think I understand the question. The timing for this is, I assume you're not with a publicly traded entity or have any publicly traded entity requirements. The timing for this is for the year beginning after December 15th, 2021. So if you're a December year end, it would be the first year would be December 31st, 2022. If you're a June year end, the first year would be the year ended June 30th, 2023. I think I said that correctly.
Yeah,
Julie, Frank, you're both
correct. Correct.
you're both nodding, so okay, I did say it correctly. If that didn't answer your question, please reach out. We'll make sure to be much more specific.
Let me expand on that. We talked about practical expedients. One of them is that if you have an expiring lease, and that doesn't mean 10 years from now, but over the next 12 months or so, you are able to continue to account for that lease as under the prior standard, which was,
Correct.
of course, FAS 13.
Okay, we have another one in here, and this is a multiple part question. Is it appropriate for my CPA to help me implement this? And the second part of that, is it going to be expensive?
What, do you want me to
The answer, well, I'll answer the first one without any question. The answer is it depends. It depends on what type of services your accountant is doing. If they're doing an audit, it gets a little hairy with the independent standards. Can they assist? Probably. Can they do it completely for you without you taking responsibility? The answer is no. Depending on your entity, if you can use some of the practical expedients that we only touched on, and we did that intentionally, it could be very expensive or it could be inexpensive. The answer is it depends on what has to go into your calculation. Joe, did you want to add to that?
I do. If in terms of how expensive it is, it really depends on how many leases you're talking about, the complexity of the leases, whether they're embedded leases and you need to bifurcate the contract and the lease. And so it can be very expensive because it could take much time. So it really kind of depends on what you're talking about. If you're talking about a simple lease, a 5-year lease to lease office space with no extensions or termination clauses, it's really simple. It might not take that much, but it will take some time to calculate the present value of the lease liability. Okay.
With that, we have a few more minutes. Well, we have 1 more minute for Julie and a few more minutes we can stay as long as you need. I don't see any other questions in the chat. So I think based on that, I guess we can wrap up, as you will get these slides, which include each of our email addresses. I believe you have our phone numbers and the way to get in touch with us. We would be happy to help you and assist you in this project. With that, I think we're going to wrap up and call it a day. And thank you for joining us today. We appreciate you. And with that, have a great rest of your day. It's a beautiful day outside. I hope everyone can get out.
Thank you.
Thank you.
Thank
Thank you.
you, everyone.